Every year, the US government loses a staggering $645 billion in revenue due to tax avoidance schemes employed by some of the world's largest corporations. Amazon, Google, Tesla, you name it, every single one of them finds a way to avoid paying taxes. So, how do they do it? Well, the answer is simple and lies within the loopholes of the US legal system. In this video, I'll break down the 3 biggest strategies companies use to avoid paying taxes in the United States. Before we dive in, it's important to understand the difference between tax evasion and tax avoidance. Tax evasion is illegal. It's when someone deliberately refuses to pay taxes they owe. Tax avoidance, on the other hand, is legal and involves using loopholes in tax strategies to reduce these tax bills. With that clear now, we can go into the 3rd biggest contributor of tax avoidance: tax credits. The 3rd most common way companies avoid paying tax is through tax credits. While designed to reward companies for beneficial activities, such as investing in innovation or adopting clean energy, tax credits often become tools for corporations to drastically reduce their tax bills. Tax credits are effective because they directly reduce the amount of taxes you owe for every dollar of credit. Your tax bill goes down by $1, making them a strong tool for saving money on taxes. When overused or abused, they deprive the government of critical revenue and shift the burden onto ordinary taxpayers. The Research and Development Tax Credit is a prime example. Created to encourage innovation, it was intended to stimulate economic growth and benefit society. However, it's become a widely exploited loophole for some of the world's largest corporations. Consider Amazon, which reported over $13 billion in profit in the 2020 tax year, but paid only $162 million in federal taxes, an effective tax rate of just over 1%. A significant reason was its use of the R&D tax credit. By classifying operational expenses, such as software development, as qualified research, Amazon claimed substantial tax credits, reducing the tax it had to pay by hundreds of millions of dollars. While Amazon invests in innovation, the scale of its savings raises questions about whether the credit is incentivizing genuine research or simply being used to avoid taxes. But that's not all. Renewable energy credits, like the investment tax credit and production tax credit, follow a similar pattern. Designed to encourage clean energy adoption, these credits allow companies to deduct a percentage of their investment costs directly from their tax bills. While they have driven growth in renewable energy, they also provide large corporations with significant opportunities to reduce taxes. For instance, a company building a solar farm might claim the investment tax credit to dramatically lower its taxable income. I don't think we, as a society, properly consider the massive impact avoiding taxes this way has on society. Every dollar saved through tax credit is a dollar not going to public funding. The US tax gap, the difference between taxes owed and paid, stands at $645 billion annually. While tax credits are not the largest contributor, they play a notable role, representing billions in lost revenue that could fund infrastructure, education, or healthcare, or just generally improve the deficit in America as a whole. It simply isn't fair on a whole scale. Big corporations with lots of resources use tax credits and lobby for those tax credits to save huge amounts of money, while small businesses and regular people end up paying more. Most Americans can't afford fancy tax strategies, so they pay their full share, while corporations, with the money to fund those lawyers and tax strategists, only pay a small part of what they technically should owe. This makes people lose trust in the fairness of the system as a whole. Tax credits themselves, again, aren't bad. They were created to support things like innovation and renewable energy, but without better rules and oversight, they can turn into a way for the richest companies to avoid taxes. Fixing the system is important to make sure tax credits work as intended and keep the system fair for everyone. The second biggest contributor to the tax gap is accelerated depreciation, a seemingly mundane accounting concept that has become a powerful tool for corporations to significantly reduce their tax bills. Originally designed to encourage economic investment, it now serves as one of the most effective methods of corporate tax avoidance, shifting the financial burden onto the average taxpayer yet again. You won't believe how this works. Normally, when a company buys assets like machinery or buildings, it deducts the costs gradually over the asset's useful life. Accelerated depreciation, however, allows companies to claim large portions of the cost in the first few years. This front-loading reduces taxable income immediately, effectively deferring taxes that may never fully be paid. For example, if a company invests $10 million in equipment, regular depreciation would allow it to deduct $1 million annually over 10 years. With accelerated depreciation, it can deduct $5 million or more in the first year alone, slashing its taxable income by millions. Companies repeat this strategy year after year, compounding their tax savings. Oil and gas companies are some of the biggest beneficiaries of this rule. They invest heavily in infrastructure like drilling rigs and pipelines, using accelerated depreciation to write off these costs quickly. In 2020, several large oil companies paid little to no federal taxes, despite earning billions in profits, largely because accelerated depreciation allowed them to erase much of their taxable income. Tech giants like Amazon and Google also leverage this strategy. Amazon offsets its massive spending on warehouses and delivery networks with tax savings from accelerated depreciation, significantly reducing its federal tax bill. While these investments drive innovation and growth, they also drain federal revenue, contributing to the $645 billion tax gap, the annual difference between taxes owed and taxes paid, like I mentioned before. The system favors big corporations with the money to make large investments, leaving small businesses at a disadvantage since they often can't afford these upfront costs. This creates an uneven playing field, making it harder for smaller companies to grow and compete. This is a complex issue, though, with no easy solution. However, one possible approach is to set limits on these tax breaks or ensure that the deferred taxes are eventually paid. This would preserve the economic benefits while preventing the unfair shifting of the tax burden onto others. But finally, shifting profits overseas is also one of the biggest reasons for the US tax gap that you might have heard of, costing the government about $100 billion each year. It's a common method used by large corporations to avoid paying taxes. The practice is completely legal, but it is often widely criticized. It allows companies to move their US earnings to countries where corporate taxes are fairly low or don't exist at all, letting them avoid paying much, if any, taxes on their profits. Here's an example of how this works. A company makes a lot of money in the US, but uses tricky accounting to send its profit to a branch of that company in a tax-friendly country, called a tax haven. This often involves transferring ownership of valuable things like patents or trademarks to that specific branch. Then the US part of the company pays a really high fee to the tax haven branch for being able to use those patents or trademarks in their work, reducing how much income is actually taxed in the US and transferring that income over to the tax haven. The profits are just reported in that tax haven where taxes end up being low or non-existent. One famous example is Apple. For years, Apple sent much of its international profits to Ireland, where corporate taxes are much lower than in the US. The company kept billions of dollars in overseas accounts, avoiding US taxes on that money for a long time and saving billions. While recent tax changes ultimately forced Apple to bring back some of that money, this strategy helped the company significantly lower its tax bill. Google also gained attention for its clever but controversial tax strategy nicknamed the Double Irish with a Dutch sandwich. This involved moving profits through subsidiaries in Ireland, the Netherlands, and Bermuda to greatly reduce its global tax bill, including what it owed in the US. Again, while legal, this strategy drew criticism for exploiting loopholes to minimize taxes. Similar to tax credits and accelerated depreciation, this practice reduces the government's revenue, leaving less money to invest in the country. It also shifts the tax burden onto smaller businesses and regular taxpayers who can't take advantage of these strategies. This practice also creates unfair competition. Large multinational corporations gain a major edge over smaller businesses that operate mainly in the US and pay these full federal taxes. Offshoring profits also damages public trust. When people see corporations like Google and Apple avoiding billions in taxes, it makes them feel the system is unfair. Unlike these companies, most individuals can't move their income to a tax haven to lower their tax bill. Efforts like the 2017 Tax Cuts and Jobs Act aimed to curb offshoring by introducing a minimum tax on foreign earnings, but these measures haven't fully solved the problem. Multinational corporations still find other ways to exploit gaps in global tax rules, showing the need for stronger reforms. While offshoring profits is technically still legal, its societal cost is enormous. Policymakers must close these loopholes to ensure corporations pay their fair share and support the communities where they make their money. If you enjoyed this video, don't forget to click subscribe.